Hey, what's going on, traders and investors? Thanks for checking out this video. My name is Travis from Master the Market, and in this one, we're going to be talking about how you can make 3 times the average market return with just one simple investment. So first and foremost, one thing to keep in mind is that based on the S&P 500, the average market return over the span of an entire year is about 10%. So some years the S&P may go up, 20%, some years it may go down 20%, but on average, in the long run, that's going to average out to about a 10% return on your investment every year. So over here on the left side, we have the S&P 500 ETF, which is SPY, SPY. And as you can see, if you look over here to the right, we have a chart that is basically identical to that of SPY's. The only difference here is that this is the symbol for UPRO, and UPRO is going to actually be what is known as a 3 times leveraged ETF for the S&P 500. So that just means that every time SPY goes up 1%, UPRO goes up 3%, and obviously vice versa is true as well. If SPY goes down 1%, UPRO is going to go down 3%, obviously making it a little bit higher risk and higher reward, but it is a great option for anyone that's looking to kind of maximize their returns in the stock market and don't necessarily want to just settle for the 10% per year that the S&P 500 is going to average out to. Now, before you go and sell all of your shares of SPY and start buying up UPRO, it is very important to kind of understand a little bit more about how it works because there are some other risks that are associated with trading and investing in UPRO. So to kind of break that down for you, I'm going to pull up a text box here. Okay, so let's just say that for this example, we have SPY that's trading at $400 per share. And then over the span of a week, let's say that SPY fell down 10%, falling $40 per share down to $360. Now, in order for SPY to get back to break even, it doesn't have to just bounce 10% from that 360 level, because 10% of 360 would then put this back at $396. So it would still be down 1% from the initial $400 price. So it has to bounce 11.11% from 360 to get back to break even at $400. Now, bear with me here for just a moment, but let's take the example now with UPRO. Let's say that UPRO started at $50 per share, and because it is a 3 times leveraged ETF, when SPY falls 10%, we know that UPRO is going to fall 30%, which would put it at a price of $35 per share. And then as SPY bounces 11.11%, UPRO is going to bounce 33.33% from $35, and that's going to put it back at a price of $46.66. So while SPY is back to break even from $400 down to $360 and then back to $400, UPRO is going to be actually at a loss still of about 6% from what is known as volatility drag. Now, I know it sounds a little bit confusing, and that's kind of because really it is confusing, but what you need to know is that timing with UPRO is going to be exceptionally important because even if SPY gets back to break even from where you invested in UPRO, your position in UPRO could still be at a loss. Now let's go back in time a little bit and take a look at the longer term time frames here for SPY and for UPRO. Okay, so we could see that right here when the market crashed, this was at the peak of the COVID-19 pandemic. We saw that SPY fell down to a low of $218.26. Over the next, about 11 or so months, SPY bounced all the way back up and ended up running to a new high of $479.98. Okay, so in that time frame, SPY went up over 100% from the lows, which obviously, since on average it returns about 10% per year, that would of course be a great return on your investment. But if we kind of compare that same time frame here with UPRO, we saw that UPRO went from a low of $8.76 up to a high of $78.72, which is about a 900% return from the low. So obviously you can see how lucrative it can be to kind of time things perfectly with UPRO. It is definitely something to keep in mind as the market is currently pulling back a little bit from its highs. I'm not saying necessarily that right now is a great time to buy UPRO, but it is definitely one to keep on watch. And once the market does start to recover from its current pullback, it's definitely going to be one that I'll be loading up on some shares. And even if you're not necessarily looking to get into anything longer term right now, if you're a day trader or a short-term swing trader, UPRO is also a great option for that because if you think about it, SPY over here is $424.70. which obviously has a very high cost for those that are looking to day trade or do some short-term swing trading with. So UPRO would be a much more cost-effective way to kind of trade the S&P 500 on a shorter-term time frame. And also very quickly, for one more example, we also have the TQQQ, which is the exact same thing as UPRO, but this is going to be for the NASDAQ 100 instead of the S&P 500. And if we compare the TQQQ to the QQQ chart, you can see that they are identical. And that's because, again, TQQQ is to QQQ as UPRO is to SPY. Okay, so both of these, TQQQ and UPRO, are great options for anyone that's kind of looking to maximize their returns in the stock market with their longer term investments. Obviously, like I mentioned, they are a little bit higher risk and higher reward, but still in the long run, they are generally pretty safe investments as they are still representing the S&P 500 and the NASDAQ 100, which historically have been great investments. Okay, so hopefully you found some value in this video and you enjoyed. If you did, please make sure to give it a like and subscribe to the channel. And if you want to learn more about day trading, swing trading, and long-term investing, and join our team of traders, you can find more information on that at my website, Master the Market, which will be the first link down below in the description. But anyway, thanks again for watching. I hope you enjoyed, and good luck with your trading.